start with the selling your house process. A lot of people come to me and say, well, I'm selling my house. I'm probably going to make that much, a lot of money. What are my tax implications?
That is a great question. And for many people these days, there is no taxable gain, which is really nice. It's one of the few really good tax benefits. So if it is your principal residence and you lived in it for at least 2 out of the 5 years prior to sale, you can exclude up to $250,000 of gain if you're single and $500,000 of gain if you're married. So for the bulk of the people out there, there's nothing. So if that is the case and you are not issued what's called a Form 1099-S, you don't even have to report it on your tax return, which is super nice. Now, on the flip side, if you sell it at a loss, it's just a personal loss and you don't get any deduction. People call me all the time, like, just, because there's both sides of it, which is really nice if you happen to buy a house that's, appreciated. Now, there are people that do have taxable gains. I mean, my mother bought her house for $47,000 however many years ago. She has a taxable gain. But for the most of it, you're only paying the tax on what's ever above that. So that's really nice for most people. Especially now, if you get that 1099, or if you have a taxable gain, or if you had a home office, you do have to report that. So in that case, you need to make sure that you have the closing statement, that HUD-1, the form with all those lines on it, that you will need, because you take the sales price less all the closing costs, so that you net less, and then you compare it to what you paid for it plus the closing costs plus any capital improvements you make. So not little repairs, but if you added on a room or you added appliances or all that gets there. So it's really important when you are a homeowner that, one, you keep all those closing statements. You don't need the whole packet. I mean, I've never seen, it's crazy in real estate how many
3-4 pages. Yeah.
But just that HUD-1, you need to make sure you keep, and then any capital improvements, you want to just keep a folder with all those on there. Plus, it's just good for your own knowledge to know where, even if it's not taxable, did you make money? Did you lose money? Where is it at? Just for your own information. But that's how you do it. Now, if you had a home office, that part of your house is not considered principal residence. So that percentage has to get carved out, and that is going to be taxed if there's a taxable gain, because it's not a principal residence. So that one, there's a separate form that you calculate it on, and the same way. And then if there is a gain, it's taxable at 25% on the federal side, up to the amount of depreciation that was taken on that property, which is a whole different ballgame, and I won't get into it right now. But and then the rest is taxed at long-term capital gains rate. So it's still not bad, but just keep in mind that if you have reported that home office on your tax return, they're going to be looking for that. So I still think it's worth it to take the home office if you actually have it, but just don't forget that part of it.
Yep. And what I'm hearing from this information is, when you're buying your primary residence, you should keep track of all your improvements from the day one, because that's going to play at the end when you decide to sell it.
Yes. So people are like, oh, I did this. Do I get anything? I'm like, no, just keep it. Now, one other thing upon sales is in Illinois, we pay real estate taxes a year in arrears. So, in 2021, we're paying our 2020 liability. So when you sell a property, you have to pay at closing for the time up until the date you sold it. So you're going to pay additional amounts on that closing statement. So while that's not included in the calculation for the gain or loss, and a lot of people don't get the benefit for that on their itemized deductions, Illinois does give you a property tax credit. So you want to make sure that you add that amount in so you get the full amount of your property tax credit on Illinois, because a lot of people miss that. On the flip side, when you buy it, you get a credit for the taxes that you're going to have to pay out from the prior owner. You have to subtract that.
Yeah.
People do that wrong.
Yeah. It's nice to have professionals who can just do it. So